Welcome to Kaleidoscope by HDFC MF, an effort to guide key conversations in the Indian financial markets and investing ecosystem. Today we look at resilience of the Indian stock market during strong foreign outflows seen in the recent past. Indian equity markets have been recovering from a more than 13% fall in markets January to March 2022. The Nifty 50 index as of 28 February 2022 was lower than the current year high by 6% and lower than the beginning of the year by 1%. While the period saw rising global macro and geopolitical uncertainty, it was particularly marked by the largest foreign outflows seen in a quarter. As on 25th March 2022, foreign portfolio investors have sold INR rupees 1.1 lakh crores in this quarter. Such large outflows were last seen at the start of the pandemic in March 2020. Past instances of high foreign portfolio investors' outflows, as highlighted in this table, saw very high turbulence in the Indian markets and saw market drops of over 20%. This time, however, the market impact was significantly lower. Significant buying by domestic institutional investors was observed in the same period, approximately INR 1 lakh crore. Retail investors too have seen increasingly higher traction in the Indian markets, evidenced in the fact that investor accounts with depositories have more than doubled over the past 2 years to 8.7 crore accounts. Given high concentration of the FPI portfolio in certain sectors like IT, financials, and banks, they bore the brunt of higher foreign selling. A key sector with heavy weight in FPI portfolio that saw relatively lesser selling was energy, which has seen tailwinds on account of higher commodity prices, specifically crude oil. The aggregate FPI portfolio as at 15th March had 17% of their portfolio in banks, 15% in IT, 12% in financials other than banks, and 11% in energy. Sectors with high FPI selling did underperform in the current quarter. While the Nifty 50 is down 1% since the start of the year, Nifty IT Index is down 7%, and NSE Financial Services Index is down 4%. A key takeaway amid the recent episode of FPI outflows is that Indian equity markets, over the years, have grown relatively immune to the direction of FPI participation. This can be seen with the muted impact on broad market indices. Further, the recent past having seen large quantum of FPI outflows, any mean reversion or a reverse swing of the pendulum could see a positive reaction in the markets. The key immediate risk would be rapidly evolving geopolitical situation surrounding Russia-Ukraine crisis, which is likely to determine the near-term trend of FPI flows. Thank you for joining us today. We will be back soon with another interesting piece in this Kaleidoscope series. Until next time. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.